So while stocks have partied post-election, gold has been sitting home alone watching Seinfeld reruns. The precious metal has dropped some $70 since Election Day. Billionaire investor Stan Druckenmiller, whose biggest holding as recently as May was gold, announced on our competitor CNBC that he unloaded all of it on election night. So some people went and said, I'm going to do what he says. But a whippersnapper based out of Texas said, bad move, Druck. Drew Mason of Dillon, Gage Metals blurting out, quote, Druck's words are covered in Kool-Aid. His advice will prove ill-advised. Investors will wish that they had done the exact opposite. So we thought, bring in that younger whippersnapper, Drew Mason, Dillon Gage Metals director. He's also manager of the Palace Harbor Gold Fund. First Trust Bank's chief economist, Brian Wesbury, though, taking the other side, siding with Druckenmiller, and he's our bear on gold. Let's kick off the bull-bear debate. Welcome to both of you. All right, Drew, gold's at 6-month lows. Stocks are hot, and you're saying I'm going against the billionaire. You tell us why.
That's exactly right, Liz. Right now, the equity markets are swimming in optimism post the Trump win. It's as if we're going to be able to correct our debt problems, our trade issues with the trade treaties that have been put in place, immigration quickly and painlessly. We think that type of optimism feeds on rising equity valuations and has contributed to gold's sell-off. We think Druckenmiller's call will be seen with the equivalent of the death of equities call in 1979, doing the wrong thing at the wrong time here. In theory, it may prove okay academically to have made such a suggestion, but what we think Wall Street really doesn't understand is that in practicality, when investors go and they begin to try and leg back into gold, there just simply is not enough physical market cap available to get in without moving the price. Asia's largest banks tell us if 0.5% of equity money moves towards physical gold, it will have to move multiples from its current price to accommodate that diversification.
Okay, to you, Brian, you're looking at all the signals and you see something completely opposite.
Oh gosh, yes. It's a risk-off trade. I mean, risk-on trade since Trump won, and it's not because all of our problems are going to magically disappear, but we're going to see a move toward a pro-growth environment. And whenever you have more real growth in the economy, you have less inflation. And as a result, you're going to see a move toward equities. And don't forget, equities pay a dividend, equities have earnings, gold doesn't have any of those things. And then the final point I would make is that as we were going into the election, I'm not worried about what Druckenmiller says. This is what I was telling our clients. Stocks are undervalued and gold is overvalued. Gold is worth about $800 an ounce. Stocks should be worth 25% more than they are today.
True, Drew?
And it's because...
Is gold really, should it be valued at $800 an ounce?
Well, if you look at the price of gold relative to the supply of fiat currency, which is the antithesis, the counterparty for physical gold, the prices would be materially higher to get to fair value. What we see happening, Liz, is that as investors realize growth has its limits, valuations have their limits, the equity markets are already at 3 times the multiple of when Druckenmiller first suggested to buy equities here. They will begin to say gold makes some sense. 0% is wrong.
The one thing I would say, Drew, is that when you talk about fiat currency, if you're talking about all of this quantitative easing around the world, yes, the central banks have bought a lot of bonds, they've printed a lot of money. But because banks have been regulated so much, none of that money turned into inflation. That's why we never had hyperinflation. And here's the way I look at it. An ounce of gold ought to buy about 16 barrels of oil. And that's been true over the last 30, 40 years.
Okay, well then, Brian, what are you buying if not gold? Quickly.
Stocks. You know, the opposite of gold. I'm buying financial company stocks. Banks, insurance companies, community banks especially, because we're going to be deregulating, and this is the growth trade. I think you need to go to the growth trade. Stay away from bonds, stay away from gold. It's not the end of the world.
Drew, if you believe gold is the place, do you buy the miners or do you buy physical?
We specialize in the physical and which form factors have performed the best for clients over time because the divergence has been huge depending on what species you buy, whether it's the ETF or the physical. We think now when inflation expectations, like Brian is saying, are basically 0, that's a time to prepare with 10 to 20% of your portfolio that maybe another hurricane could blow in.
I got a Krugerrand at home. Good to see both of you. Listen, it's a great feisty bull-bear debate. Brian Wesbury, First Trust chief economist, and our bull for gold, Drew Mason, Dillon Gage Metals, director of asset management. Thanks.